Hello, my name is Neil Etheridge from Aaron Tawney. It gives me great pleasure to introduce our two guest speakers for our investment webinar. The first speaker is James Hall from Cazenove Capital. He'll be giving us an insight into the equity markets in these interesting and challenging times that we are in. The second speaker is Tom from Close Brothers Asset Management, and he'll be explaining the challenge of hunt for income. Our aim is to provide interesting yet informative presentations, and we hope we thoroughly enjoy them. Thank you.
Hello everyone, my name's James Hall from Cazenove Capital, and I'm here today to talk to you about markets, what's happened over the first 9 months of the year, and what indeed we think is going to happen going forward. Now, Neil has kindly given me 15 minutes for this task, so without further ado, I shall press on to the first slide. So to start us off, we're just going to look back at what's happened over the year to date. So what we've seen, and this here is the global equity indices, we've seen a very, very sharp sell-off which was kick-started by coronavirus in late February, early March. And since the lows on March 23rd, we've seen markets climb back, and they're now ahead of where they were at the start of the year. The US market, the S&P 500, fell 35% nigh on from top to bottom, and this ranks it as the 7th worst fall since the Great Depression. What was really striking about what happened was the speed with how it went through. The fall from top to bottom happened within 1 month, and the subsequent recovery was 4 months. If you rank this against something like the credit crunch or great financial crisis, if you will, this took 17 months to fall from top to bottom and a further 34 months to recover. So the sharpness was pretty much unbelievable. I think, though, it's a good idea to look under the bonnet, as this is just countries as a whole. There's been a lot of divergence between the different countries across the world, so let's have a look at those. In the Far East, Japan, Asia, China, what we've seen there is countries have dealt with and controlled the coronavirus a lot better, and subsequently markets there are positive. Over in the West, we have dealt with the coronavirus perhaps not as well as those guys, but in our own right, we've done fairly well. But what we have seen is European markets flat, US markets up very strongly, and the UK markets down 20%, with the FTSE 100 struggling to break back above 6,000. Now, you might think this is quite unusual if you think our policies towards the virus have been pretty much similar. So to answer why there's been such a divergence, we need to look yet deeper into the sectors in which the market is made up of. Here we can see the different sectors, and what stands out straight away is the energy sector, which is on the left-hand side. It's down 40%, which is that pink bar over the year to date. Now, energy has fallen as global oil demand has evaporated. So people are driving a lot less than they were. Manufacturing has gone down a lot. Even though those two areas have bounced a bit, aeroplane and airline travel is still almost 50% down on what it was at the start of the year. So energy supply, oil supply is down, and subsequently those companies are making a lot less profit. The other area that's dragged back is financials. Banks, etc., down 20% over the year to date. And the reason for that is really that interest rates have been cut as governments try to stimulate markets, and banks really make their money between the deposits they take and the loans they make, and when interest rates are low, they're unable to make such a profit. Another reason for financials lagging is often with a recession on the horizon, these banks are hit by markets because they feel that they will bear the brunt of any defaults on people's credit cards, mortgages, and things like that. The FTSE 100 that we saw earlier, the UK market, has nearly 50% exposure to those two sectors, and therefore it is these two that has really dragged it back. It's also what the FTSE doesn't have. Now, the FTSE only has 1% exposure to technology shares, and as you can see from the middle there, technology shares are up 30%. The S&P 500 in the United States has nearly 25% exposure to the technology stocks. So that is why that S&P has done so well. And it's understandable because tech stocks have really done impressively, and coronavirus has been very, very good for them because it's brought on what would have been 2 to 3 years in 2 months. So we've all started to shop more on Amazon. We've been watching Netflix of an evening. We're using Zoom, Google, Microsoft in the home a lot more, and you can see why these companies have earned a lot more money. A quick nod too to healthcare, which is up 10% this year after having a quieter year last year. And of course, that's by virtue of the coronavirus once again and people buying healthcare equipment and indeed medicines. I just want to have a quick look at the dividends payable on the FTSE 100, which is generally speaking the highest dividend yielding index out of the major indices. And as what we can see here is that dividends have fallen by over a third as those oil companies and banks that we saw earlier have had to cut their dividends by almost half, and this has really impacted payouts. So Shell, BP, HSBC all made big cuts, and what this meant is that the FTSE yield has gone down from 4 3/4 to around 3.5% this year. That's still a lot better than the yield in the US market, which is around 2%. So this is not good for those that want income, and I know Tom's going to come on to this a little bit later. It is actually, however, positive for companies that they are keeping this cash on their balance sheet rather than sending it back to shareholders, because if there are tough times ahead, that cash will put them in good stead. I just wanted to look at growth now, global growth. So what we have seen is that 2020 will be the worst year since 1930 for the world economy. So our analysts expect that this year we are going to see a contraction in growth of around 4.6%, but at the moment we expect that to bounce back to a growth of 5% next year. However, what we could well see if we see a prolonged and profound second lockdown is that growth to the upside could be hit. But at the moment, if we can have a lighter lockdown and get through this period, we think that growth could bounce back quite strongly. So outside of coronavirus, what other risks do we feel are out there? Well, certainly the big talking point in global markets at the moment is the US election. Now, if you said at the start of the year Trump would be behind coming into the election, I would have thought that it would have been quite poor for markets and markets would be quite jittery. But at the minute, markets are quite comfortable. Why is that? Well, firstly, Joe Biden is the prime candidate against Trump, not Elizabeth Warren or Bernie Sanders. Both of those were much more radical than Joe Biden, so that's a big tick from the market side of things. But equally, with Biden likely to get in, it's also quite likely that his Democratic Party will get control of both the Senate and the House of Representatives, making it a lot easier for them to put through their policies. And one of their major first-off policies is a huge stimulus package for markets. So the markets like the fact that they might be just about to get that from the Democratic Party. At the minute, the odds are about 88% that Biden will get in and 74% that he will control both the Senate and the House of Representatives. What I think the real risk is, though, here is that Trump, he's come back before. If he comes back again and you see some form of a close election or political deadlock, the markets won't like that because markets don't like uncertainty. That's not our base case, and we don't really think that will happen, but it's something one has to consider. Away from the election and back over the pond, we have indeed seen more Brexit talks come into the news, and we'd actually forgotten about it. And this little cartoon from Matt I thought was really quite funny and summed it up well. It's a grandfather bemoaning the fact that the COVID restrictions are stopping him from having a row with his grandchildren on Brexit. But I think this is quite true in that COVID quite rightly is taking the headlines, but as Brexit comes to the fore, it is very important for the UK. I think what I'll say about it is that Boris Johnson will use his brinkmanship to push this to the wire again. And, he may well get a deal. If he does get a deal, I think sterling and the FTSE 100 will probably go higher. However, if he comes out without a deal amidst one of the biggest global pandemics we've ever seen, it's probably not good for the FTSE 100 in the short term. So why are markets so buoyant? Why have they been rising, and why do we think they're going to continue to rise? Well, there's two main reasons. Firstly, what we call the liquidity supply. So the amount of cash in markets is huge. Governments have been printing money since the great financial crisis. You remember this term quantitative easing, which effectively means putting money into markets. You can see every year the United States has been putting 5 to 7% more money into markets, but this year they put almost 25%. They put almost $3 trillion into markets, which is very supportive of equities and bonds and share prices as a whole. So this is one of the reasons markets have been pushed higher. The other reason is the TINA effect. Now, I gave you an acronym last time I spoke to you, which was the FANGs. I hope you remember that one. This time I'm going to give you TINA. So TINA stands for there is no alternative. So what do I mean by that? So what are the alternatives to equities? So the first one is cash. You keep your money in cash. Well, at the minute, you'll get around just above 0% if you keep your money in cash. But if you put your money in bonds, i.e. you give your money to the government in the UK for 10 years, you get 0.2%. So it's not particularly attractive either, particularly when inflation is running at 1.5%. So if you leave your money in bonds or cash, really you're going backwards. Earlier I mentioned the FTSE having cut its dividend to 3.5% and the S&P has a 2.5% dividend. Well, those two actually look very attractive when you set it against 0% cash and 0.2% bonds. So you can see why people have been going into equities as they hunt yield. I'd also like to just talk about gold as well, because this is a positive backdrop for gold. If you think gold doesn't give you any income as such, but when cash and bonds give you no income as well, you see that gold becomes attractive. Gold also does well when markets fall, and it's a very, very good hedge against inflation. And we saw on the last slide that there's a lot of money sloshing around, and that can be inflationary in the long term. So if you've got gold in your portfolio, that should do very, very well. So we like gold at the minute. So really, in conclusion, we think it's going to be quite a volatile and a bumpy ride coming forward. But more than ever, one needs to be really quite selective about what one's doing in their portfolios. So at the minute, we'd favour technology shares over most shares, particularly wishing to avoid things like financials and energy. And that really leads us to having more of a bias to the US markets, as we've seen earlier, and much less in the FTSE at the minute. Although we could see the FTSE bounce back should a positive outcome from Brexit come, but I don't think you'll see it get back to par this year. And just to touch upon a few themes of ours that we have going forwards, there's 4 real key themes. The first one is tech. So I've mentioned quite a few times how much we like tech, but those companies there continue to make good earnings, and we think they will continue to earn well going forward. So tech gives you a nice robust cornerstone to your portfolios. Another area that we like that I haven't touched upon too much is healthcare. With ageing demographics around the world, and with drug companies doing better and better, we think that healthcare is a really good place to invest. And if you think about governments, you think about COVID, they are having to put a lot more money into healthcare and will increasingly have to do that going forward. So healthcare is another big chunk of our portfolios. Away from that, the theme of inflation perhaps coming through from that wall of money. As I said earlier, we do like gold and we think that's a nice hedge, but we've also been adding to infrastructure funds. So infrastructure funds tend to own things like bridges, railroads, things like that. And why we like these asset classes is because their payments are usually linked to inflation, so that we have a nice bit of money in them. Finally, just a quick nod to sustainability, which is a real growing part of our portfolios. We bring sustainability into all the decisions that we make because we think it's very important that you look for the right companies with the right ethics, and this will set you well over the long term. So that's it from me. I'm going to hand over for Tom, who's going to talk more about the income.
Hello, my name's Tom Santralai. I'm an investment specialist from Close Brothers Asset Management, and today I'm going to be talking to you about the hunt for income. Now, markets over 2020 have been a real roller coaster ride, and it's fair to say that when that happens and you see that volatility in the market, it brings with it significant levels of anxiety and discomfort for investors. Probably none more so than those investors that rely on the income generated by their portfolios to fund and sustain their day-to-day living. So I'm going to take this chance to talk to you over the next 20 minutes or so about why we've got to this situation, and also highlight some of the opportunities that we are seeing out there to generate a steady level of income for investors that require it. Now, there are a few important risks and drawbacks that I want to highlight to you. I do offer the opportunity to hit pause on the video if you'd like to take your time to read this. But effectively, what I want to let you know is that I'm going to show you a few charts, and it's important to remember as I do so that past performance is not a reliable indicator of future returns. And of course, nothing that I reference today should be construed as personal advice. If you do require some personalized advice, speak to your financial planner, and I'm sure they'll get something in place for you. So what's been moving markets so far in 2020? Now, I'm sure it will come as absolutely no surprise to you to see the word coronavirus up in big red letters on the slide there. Now, coronavirus has impacted every part and every facet of our lives over the last year or so. And it's not necessarily so much the virus itself that's impacted financial markets, but the response that governments have taken to try to stem its spreading. And that all started in sort of late March time, where we had that instruction to stay home. And in doing so, staying home meant that you and I stayed in our homes. We closed down shops, restaurants, bars, schools, factories went quiet, planes were grounded. And this environment makes it particularly difficult for businesses to make money, to generate the revenues that they had done in the past. Now, some of these stay-home rules have been alleviated somewhat, but we still do have the 2-meter rule. And all these little rules in place are making it more and more difficult to continue to do business the way companies have done in the past. And that makes for a challenging investment environment. But when we do have these challenging environments, one of the key tools that we have available to us as investors is diversification. It really is the cornerstone of modern portfolio theory. And when I mean diversification, I'm talking about asset classes. And I generally talk about the key 4 asset classes that we use within our portfolios, which are cash, bonds or fixed income, alternatives, and stocks and shares. Now, if you don't mind, I'm going to go through each of them to define them, because I do think it's worth making sure that we're all on the same page, but I apologise to anyone that already knows this. But cash, of course, is money in the bank. And as we know at the moment, with interest rates at rock bottom levels, you're not generating much of a return, if anything, on your cash. So we have to recognise we need to take a little bit of risk to generate a return. So we move up the risk spectrum towards bonds or fixed income. Now, bonds are issued by either the government or companies, and is effectively an IOU. So when that company wants to go and invest in itself to generate further growth for the future, they might borrow the money to do so. So they go to the market and they say, look, if we give you £1,000, we'll pay it back in 5 years' time, and over that 5-year time frame, we're going to pay you £20 on an annual basis as an interest payment. So you as an investor know if that company is still solvent in 5 years' time, you get your £1,000 back, but you also get that regular income of 2%. So it's a nice way of generating a sensible income and a very low risk opportunity depending on who your credit risk is with. Now, at the other end of the risk spectrum, we've got stocks and shares or equities. Now, when you're buying an equity, you're buying a share of the company because you want to share in that company's growth. And you also want to share in that company's profits, which get paid out to investors as dividends. But, of course, as we know, there's no guarantee that any company will grow, nor is there a guarantee that they'll be able to generate a profit. And therefore, it's a lot riskier. There's no clear path to confirm what sort of income you might be generating. So we use a blend of the two of these asset classes and incorporate a third one, which is alternatives as well. And alternatives is a bit of a catch-all bucket for the non-traditional asset classes. And in there, you're going to see some property, commodities, infrastructure, and some absolute return funds. But all of these come together to help diversify the portfolio. Because we do know that the old adage is true, that there are really only 2 types of economists in this world. Those that don't know what's going on, and those that don't know that they don't know what's going on. And when you're an investor, it's really important to recognise that you're probably in the latter of that. We need to recognise our own limitations in being able to predict the future. Nobody's got a crystal ball. And so this diversification is really important in helping us diversify some of that risk away and smooth returns for our investors. Now, to demonstrate that, what I've got here is a patchwork quilt, which you might have seen something similar in the past. Each column here represents 1 year of returns, and the different colours represent different asset classes and geographies. Now, you don't need to see the details of what's going on here, but what you can see immediately is that this is a multicoloured mess. There's no rhyme, reason, or pattern that flows through this. So no particular asset class is always at the top or always at the bottom. And if we look at some of the ones in more detail, you can see UK equities. They had a pretty good year in 2007, but a torrid year in 2008 when the financial crash came through. And then the year after, they recovered better, and then they've been sort of meandering through the middle somewhat. On the other side of the risk spectrum, you've got government bonds, very low risk. So they had a pretty average year in 2007, but a very good year in 2008 because people panicked, they sold their equities, and they put it into those safe haven assets. And then they had a weaker year in 2009 as the markets recovered, but also interest rates were lower. But when we play these over each other, you can see that they work in alternate directions. It's known as negative correlation. And this is what we're trying to find when we're building portfolios. We're trying to find assets that work together to smooth out the journey because we never quite know what's around the corner. And when we're looking for income for our portfolios, the other consideration is the sectors of the businesses involved. And that's really important. And I can show you from this year so far how broad that has been. So if we look there at the UK oil industry, is down over 50% this year. UK financials down around about sort of 30%. And these are really the stalwarts of income generating equities. These are the ones that pay solid dividends year in, year out. Royal Dutch Shell haven't cancelled their dividend since the Second World War, but they did so this year. So that leaves us in a tricky situation. But it's not all lost because there's some great opportunities elsewhere. If you look at the US consumer sector and the US technology, they've had stellar years. They're up at around about 40%. However, from our perspective, when we're hunting for that income, unfortunately, these sorts of business, the ones that have really benefited from the stay-home order, the ones that Netflix, Amazon, Google, the ones that we are all utilizing over the internet when we're at home, they've done very, very well, but they're very much in growth mode. So the profits they generate, they tend to reinvest back into the business to grow for the next year and the next year above. So I think that we need to somewhat temper our expectations as to what we can expect from the equity component of our portfolios, and maybe focus on some of the other asset classes to try and produce a bit more of a steady income stream. But that's not to say we're going to reduce our equity exposure altogether, because, as I said, that growth coming in from the US is still very good for the total return of the portfolio. So every asset class is playing its own role within the portfolio itself. So here are our asset classes, and now we're going to look at bonds, as I said, those IOUs. Now, bonds, like your mortgage or my mortgage, are very much linked to the Bank of England's rate. So the rates of central banks around the world are at rock bottom levels. So borrowing is very, very cheap. And that's the same for the bond market. And one of the safest assets that you can find are government bonds. And to see how those interest rates have impacted those, you can see the yields here up on the screen. If you were to lend the UK government money for 10 years, you would only be returning 0.5% in income. It's nothing. And you compare that to the European market, where you'd actually be guaranteeing yourself a loss because they're in negative yielding territory. So where does that leave us when we're trying to find a steady income? Well, fortunately, fixed income markets are very broad and nuanced, and there are areas that we've been able to find a rich vein of opportunity when you know where to look. Now, they all come with different risks, and it will depend on the counterparty that you're lending to. But one area that we found great opportunity is in this area here, the unrated bond sector. Now, in modern society, we're all very much obsessed with ratings. I know that my wife won't buy anything on Amazon at the moment unless it's got at least 300 ratings. Who knew that buying an extension cable would be hanging in the balance from Kevin in Kentucky's most recent review of it? But that's the way we are. But if we think back to how it was before, when we were booking our hotels not using TripAdvisor, but doing the hard work. And you thought to yourself, well, actually, I don't want to go to the hotel that everyone's going to. I want to go off the beaten track slightly. And you find that boutique hotel that's a little less crowded, is at a very good price, and the service is fantastic because there's less clients. And that's your reward for doing the hard work. And the bond market is very similar. If you're willing to do the work and you've got the expertise to do so, you can uncover these unrated bonds that are generating about 3% extra return. Now, unrated doesn't mean riskier. It just means that one of the 3 big rating agencies hasn't rated it. You might know them: Fitch, S&P, and Moody's. And by not having that rating, the vast majority of investors will try to stay clear. But we have a former ratings analyst on our team who takes those the businesses that have opted not to have a rating, and he does the hard work. And the companies that will be doing this sort of bond issuance there are very good reasons why they might not go for a rating. For example, Sainsbury's there is a huge business, about 4.5 billion in market cap, but they've only released about 250 million pounds worth of bonds. Now, to get a proper rating would cost them somewhere around about 2 million pounds. So it just doesn't make financial sense. So they go to the market and they say, look, here's our balance sheet. This is our business model. If you're comfortable with the two and you've done your research, lend us the money. And given that you've done the hard work, we'll pay a little bit extra for it. And this is one of the areas in which we're able to find a little bit of extra income to help support portfolios while we're in a slightly tricky environment. The other asset class that we mentioned was those alternatives here. And alternatives do come in all shapes and forms. Now, a lot of alternatives that you'll see in many standard portfolios will include the likes of gold. And that's really important because, as I mentioned before, they act very differently to other asset classes in a negative correlated fashion. So when equity markets sell off, often people go to gold because they see it as a safe haven environment. But unfortunately, you don't get paid an income for holding a gold bar. Similarly, absolute return funds. Now, they're a little bit complicated and opaque, but generally speaking, these are the funds that are trying to produce a positive return in all markets. They're ambivalent as to whether markets are going up or down. But again, these sorts of funds, they don't pay an income because they're reinvesting it to other solutions. So what we're having to focus on to generate that income is other areas, such as infrastructure. Now, infrastructure projects has been fantastic for us over the course of this year. And these are projects that are government funded. So it's the UK government that is your counterparty. And they're building schools, hospitals, roads. These are things that have very inelastic demand. And you might wonder, well, what happens when the pandemic strikes and there's no children at school? Well, actually, the contracts involved in these are on an availability basis rather than a utilisation. So that means although there's not bums on seats in the classroom, the government still has to pay the agreed income on interest. And so that makes a nice steady return for investors such as us. And another environment that's been very fruitful so far has been green energy, so solar farms and wind farms, again, generating between 5 and 6% income on an annual basis. And the final one I wanted to mention is property. Now, property is a very broad area that you can invest in, and there are potentially some sticking points that you need to be careful of. You probably might not want to be too invested heavily in commercial real estate or retail because people just aren't going to shops, they're not going back to their office. But there are areas such as retirement homes that have been very fruitful so far this year. But one area that's been particularly good is warehouse and logistics warehouse and logistic REITs. So these are retail investment trusts. Because, as I've mentioned earlier, we're all at home, we're buying online. So rather than going to shops, it's the companies that are selling their produce online that are making the biggest impact on the economy. And what do they need? They need warehouses to store their inventory before sending it off to whoever it is that's purchasing them. And so this is an area that so far we've been concentrating most of our property investments towards, and it's been generating a nice 5% yield through the portfolio. And the final asset class that I'll mention is cash. Now, I've already said to you that it doesn't generate an income, but that doesn't mean that it's not important because cash is our dry powder. We never know what's around the corner, as I've already mentioned. And when you've got that dry powder available to you, if we do see some volatility, volatility brings with it opportunity. And if you're able to buy an asset that's yielding a good income at a lower price, then your income naturally, the yield increases with that. So we kept some firepower on the sidelines, ready to capitalise on any opportunities that might present themselves in the coming weeks or months. So what might that look like when you package that all together? Well, one solution, and of course this isn't a recommendation, is the Close Brothers Diversified Income Fund, which since the manager has taken over this fund back in February 2011, has been outperforming the peer group on a steady basis, generating an annualized return of about 5%, but crucially 4% of which is paid out on an annual basis in quarterly payments, helping to maintain that standard of living to those that require it. This is at the lower end of the risk spectrum, and it's certainly not the only thing that we do at Close Brothers. We currently manage about £14 billion worth of investments across a broad spectrum of solutions. But if you did want to speak about anything further, please do talk to your financial advisor. And so with that, I'm going to say thank you very much for giving me the opportunity to speak with you today. I hope it's been interesting to you. Take care. Bye-bye.
A huge thank you to both Tom and James for their interesting, informative presentations. We trust you feel exactly the same. If they have, however, raised any questions or there's anything you're not sure of, there will be contact details at the end. It only remains me to thank you very much for investing your time, and we look forward to seeing you soon. Goodbye.